Hello and welcome to the Cattle Marketing Cash Market Basics module. My name is Darrell Peel. I'm the Extension Livestock Marketing Specialist here at Oklahoma State University. In this session we're going to look at cash cattle markets, the basic market information that cow-calf and stocker producers in particular take a look at, and how market information impacts their decisions and how they can utilize this information. Before we start that, a bit of an overview to get a perspective on the role of different sectors of the industry. The beef industry is a very complex industry with multiple production sectors, all the way to very diverse final markets. Cow-calf production, stocker feedlot production, we often think of these as separate industries. They're done in different parts of the country in many cases by different producers, and yet ultimately there's one job in this industry, and that is to produce animals that eventually are ready to slaughter, that have desirable carcass characteristics that make it valuable and possible to market those meat products that come from those animals. So there's a lot of connection between these markets, even though it's different people involved in those industries. And the economics and the price signals that we see in the industry impact those. Before we get into more of the specific markets, consider how the beef industry has changed over time. Cattle inventories have trended up to a peak in the mid-1970s. They've generally trended down since then. So we see those long-term trends in the industry in terms of animal numbers. One of the other main features that you see is a tendency for these cycles of inventory to go up and down, whether the market is or whether the industry is trending up or trending down. We do have these tendency for cattle cycles, and in fact, if we take the data in this chart and look at it on a cycle by cycle basis, and we're going to do this from low to low in those numbers, it looks like this, and you can see certainly going back for almost a century now, and really beyond that, that we've had a tendency for these cycles, and from low to low, we talk about a 10-year cattle cycle. The fact is very few of them are exactly 10 years, but they average about that. We've had a couple that were 9 years in length. We've had a couple that were 11 or 12 years in length. One that was 14 years in length from low to low. And so there's this tendency. There tends to be a price cycle, which we will see in a minute, that's roughly opposite of this. So low inventories usually occurs at a time when we have high prices. Those high prices stimulate additional growth in the industry. And so we see inventories rise, and eventually that will cause lower prices and so on. And it's a continuous set of cycles regarding inventory and production. So we see cattle prices go up and down over this. We'll look at these in just a second, and that means that producers have an opportunity to change their decisions over the course of cattle cycles, potentially. Some producers don't, but if they don't, they're going to be certainly exposed to the variations in the revenue side of the equation, at least, that's going to happen. Are cattle cycles changing over time? I think we're going to continue to see cattle cycles. We do see some changes in the nature of cattle cycles. One of them is that the cycle focuses on cattle inventories, and yet what really drives market prices ultimately is total pounds of beef production. And as the beef industry is much more efficient now than it once was, we get a lot more pounds of beef per animal. That means that we don't have to necessarily see as much change in animal inventories to affect the needed change in beef production that goes along with these cyclical variations over time. So there may be some modification of cattle cycles over time, but I think we can expect to continue to see some cyclical nature to this industry, and we should be aware of that as producers and think about how that might impact the decisions we make. You can clearly see that here. If you look at cycles, we had a peak in the early 90s to a low in the mid 90s, back up to a peak in the mid 2000s, dropped off a bit. And then, of course, we had a very exaggerated set of peaks in the last 5 years or so. That's very unusual. You can think of it as a cyclical peak, but it was really more than that. It was a unique set of circumstances that we are not likely to see again, certainly not very soon, if indeed ever. And so it exaggerates this chart somewhat, but it really is underneath it all, the cyclical nature of the industry is still very much the same. So cattle cycles over a period of years are one factor. Another factor that producers need to be aware of is this tendency for seasonality of prices. Cattle are produced outdoors. They're subject to the annual growth patterns of forage and feeds, and as a result, and the cattle have a roughly 1 year reproductive process. So there's a strong tendency for seasonality in cattle prices. They're different for different patterns of cattle. We'll look at these in just a second. And certainly when we think about the seasonal tendencies, that can affect the basic production system that we look at for cow-calf production. It can affect considerations for retained ownership, and certainly for stocker production. You want to be aware of those seasonal patterns as you think about buying and selling cattle at different points in time. So, in Oklahoma, for calves or for feeder cattle, you can see we have very different seasonal patterns. The red line here indicates a typical pattern for lightweight calves in Oklahoma, which has a spring peak. So the months are just numbered from 1 to 12 here. So 3 is a March kind of a peak. We typically think about that towards the end of the first quarter, into the early second quarter. And then generally calf prices will be lower in the second half of the year and at their lowest in the fall of the year, when we see the bulk of the calves being marketed from spring calving cattle operations, which still predominate in this industry in general and in Oklahoma as well. For the heavier weight feeder cattle, you get a different pattern. You typically got the lowest prices at the end of the year and at the beginning of the year, and then prices increase through the first half of the year to a mid-year peak in about July or August, and then typically drop off again in the fourth quarter. So being aware of those can be an important consideration for marketing calves. In fact, again, back to the basic production system, as we noted, most of the calves in the state and in the country, the majority of them are still spring-born calves. They're marketed in the fall, which causes this seasonal pattern, but it's also one of the things that producers take into account. One of the potential advantages of fall calving cows is the fact that we would be weaning those calves back over here in anywhere from April to perhaps June, but April and May predominantly, when we're still closer to that seasonal peak, and that's one of the potential advantages of say spring calving cows. From the standpoint of marketing calves, instead of selling them at the fall low when calves are weaned, if we're talking about spring calving cows, retained ownership may be attractive for a number of reasons in terms of resource use and cost of production, which we will talk a bit more about. But one of the advantages is just the opportunity to move these calves from selling at the low of the year to selling them as bigger feeder cattle sometime after the first of the year, when those prices are rising, if not at a seasonal peak, at least rising up from a seasonal low. So those seasonal patterns become very important, also considerations on a year-to-year basis. Seasonal patterns tend to be very strong, and so year in and year out, they're one of the more reliable signals that we can count on. Obviously, nothing occurs exactly the same every year, but seasonal patterns are very strong. So when you put all of that into the context of marketing calves, it's important to think about these calves as being different animals for different markets. Sometimes it makes a lot of sense to not think about marketing all the calves as a single marketing group at one point in time. It depends on numbers, how much flexibility a producer would have to maybe break these calves up into different marketing groups. But where the numbers allow it, certainly there's reason to consider the possibility of, for example, marketing the steers different from the heifers. Or maybe the consideration would be in terms of thinking of pulling the heavier weight end off and going ahead and selling them at weaning, but thinking about retaining the lighter weight calves into a stocker program where you could put some additional weight on them. For heifers, there may be an opportunity, depending on the situation and the quality of the heifers, to think about marketing them as feeder heifers versus as replacement heifers for breeding. So again, there's different outlets for these things. It's important to be aware of sort of who else in the system wants these calves, where are they going, how are they being used, and relative to the timing you have on when you can or have these calves available to sell. So what's the best marketing alternative for each group of calves? Do we want to sell them at weaning? Do we want to think about retaining ownership? We'll look at the value of gain and that as a possibility here in just a minute. And then even where and how to sell them. Again, depending on numbers, it may make sense to think about not necessarily using, for example, a local auction. Always, it may make sense to think about whether or not there's advantages in moving those cattle to a different marketing channel where they might be exposed to a different set of buyers. There's certainly opportunities in some cases for special marketing arrangements, for example, for preconditioned calves to be marketed in a special sale, that sort of thing. So it's important to think about those considerations for marketing these calves.